Okay, welcome everyone.
We could play a game. Let's stump Phil with a question. 1031 question.
I have a great one.
Go ahead.
If someone does a 1031 exchange from a California property to a Nebraska property,
Got it.
I understand we have to file that form every year to let California know we still own the property.
Right.
What happens if one of the spouses passes away? Does the other spouse receive the property at stepped up basis? And if they sell it, will they owe California any capital gains tax?
Well, let's assume it was in a trust. Let's assume they get a full stepped up basis. I think I've never actually spent a lot of time with the form, but I have a feeling the form gives you an out because you have to file the form every year. But when you have a stepped up basis, you may not have to be able to check. You may not have to keep filing that form after you've told them what had happened. So, because remember, it's based on a taxable event. And what's a taxable event? Selling the property when there's capital gains tax.
Right.
But if there was a full step up, there may not be a need for it anymore. So I would just definitely double check with a good CPA, who knows the franchise tax board's working pretty well. And like the guy who's going to be joining on our call, Pete Muffaletto, and he would be, I would think that you wouldn't have to file it anymore, but Pete would know more about that than I would. But logic would tell you that if there's a stepped up basis.
Yeah, but we're dealing with California, so logic's out the window.
Well, I would tend to agree with you about that. Speaking of that, Pete's going to talk a little bit about what's happening, with all the proposed tax increases that they're talking about now. California is trying to create a proposed tax. They have a proposed tax increase as well, which they tried to pass at the end of last year and wanted to make it retroactive to the beginning of 2020. So, but they were fighting with each other so much, the legislature, with their supermajority. And what happened was they couldn't come to anything, so they had to drop it. So chances are pretty good they're going to come up with something this year in terms of a state tax increase. And I guess we'll have to see. So it isn't just the feds, folks. It's the state as well. So.
Right. Hey, Phil, can you hear me?
I can hear you, Connie.
Great, great. Good morning.
Welcome.
You always ask the most intelligent questions. I'm so glad you're here.
She's on the payroll. You know that, right?
Phil, I've been dying to ask you this because I've attended other 1031s and we always hear the term boot, and that's the portion, that you have to deal with. But I thought I heard you make reference to the fact that you pay capital gains on the portion that is not reinvested.
And that is
are you telling me then, I'm hoping you are.
Mm-hmm.
Yeah, no, are you situation, two people own the same piece of property.
Okay.
They're getting ready to sell it.
Okay.
It's an investment property. One of them wants to reinvest her portion into another investment. However, the other owner says, I got lots of debts. I just want to pay off my student loans and start anew.
Got it.
Can the one who wants to reinvest do so, or is she stuck paying capital gains?
That's a good question. First question I would ask is, what does the vesting look like? If they are tenants in common, that's the first thing. The second thing is, I noticed that there are people who file a tax return as tenants in common, but on their tax return, they show it as a partnership and not just tenants in common. If you file as a partnership, you are a partnership, even though your vesting says you're tenants in common. So as long as it's not a partnership, and most are not, when they're tenants in common, they're just individuals. And let's say the property is selling for $1 million and they're equal size owners, one can take their $500,000 portion of the sale and do a 1031 exchange. The other one can pay the boot, cash out, pay the taxes, federal and state, and be done with it. And that would work. Does that make sense, Connie?
Mm.
So as long as,
unfortunately.
I'm sorry? Oh, did you say
Yeah,
unfortunately?
yeah, it does.
Yeah, okay.
Yeah, so we're
Right,
still, so
right.
just so everybody knows, we're still waiting for the other speaker to get on the call. He's having some problems getting on the call.
Yeah.
So we are
Plus,
just,
I'm gonna warn you all right now, he has COVID. He's sick, but he's still gonna make the call today. He said, I'm committed to doing it and I'm gonna do it. And I give him a lot of credit for doing that today. So my speaker has a mask on. No, I'm just kidding. but yeah, he's still stepping up to be here with us today, here, folks. So he really appreciated the opportunity to be here and didn't want to let everybody down. So he will be back on. He's just having a hard time logging in.
okay, so while we're waiting for him to log in, I'm Julie Opheim. I'm the sales manager for Placer Title in the county, and I just wanted to kind of give you our little our commercial. So seems how I have everybody's undivided attention while we're waiting. So we started in California in 1973. We are a company that is not only in California, we operate in different states. We have 6 offices in our region right now with 13 escrow officers to serve you. So we'd love to do your escrows if you are not currently doing business with us. We have great sales reps on our call right now. We have Andrea Turnquist, Raimi Manderscheid, Jackie Norman, and Cheryl Tolan, who is on the phone trying to get the other speaker on. So just wanted to give you some info. And let's see, Cheryl, are we having any luck? I know she can hear me if she's on mute, so I think she's working on getting them on. We also do all our title searching in California. So just so everybody knows that, I think it's kind of a big deal when there's lots of outsourcing going on these days. All our title officers are sitting in our Northern California facility that do the title searching for us.
Julie, I understand that some title companies send it out to other countries.
Yes. Yeah, I mean,
Which I give you a lot of
majority of
credit.
them, pretty much all of the big companies do. So all the title searching, other than maybe some long order searches, most of the larger companies will go out of country for title searching.
Yeah.
So we take pride in our Northern California title operations doing what they do.
Good, good. I applaud your company for doing that because it's very difficult to find now. Everything's outsourced.
Yeah, and it's kind of the same. Are we good, Cheryl?
Yeah, we're good. Pete's getting, thank you. Hi, there's Pete down there at the bottom. So yes, we're on.
Good.
We're ready to go.
Awesome. Awesome. Well, I think everybody that is getting on the call is on the call. So we'll Phil, do you want me to go ahead and I think I can make you the presenter. Who's going first, Pete or Phil?
I'll go first because I'll introduce him. Pete, by the way, you're muted, so you probably want to unmute yourself right now. Thank you. We can't hear you. You have to unmute.
Okay, so
there you
Phil's
go.
Going first.
That's funny. He's talking, but I still can't hear him. Pete, can you hear me? I can't hear you.
Pete, go ahead and turn the volume up on.
You may want to crank your volume up.
Yeah, turn your volume up and maybe we'll be able to hear you.
Okay, Phil, your host.
Yes. Well, good morning, everybody. Back again by popular demand. This is an encore presentation of the 2021 proposed tax increases by both the federal government and the state of California. And I'm your host, Phil Atwan with Exchange Resources, and I'm really happy to be with you. In fact, we're having a course on March the 22nd, I believe it is, of the Basic Plus. It'll be an hour-and-a-half course. It'll start on Monday morning at 10 a.m. It'll end at 11:30. And we're going to talk from really soup to nuts on 1031 exchanges. And then we're going to follow it up another date with a advanced course. So for those of you who want to go beyond Basic Plus, we'll be able to do that. We'll get you into mind-bending scenarios that the federal government will allow you to do and not allow you to do. But that's coming up. Today, I'm really proud and happy to present to you Pete Muffaletto. Pete is a very accomplished CPA who's been in the business for 50 years. Pete, you don't look a day over 49. How can that be? I've just tried to get him to talk so I could We can't hear you yet. Cheryl?
Okay, yeah, I can't hear him either. I'm going to call him and have him call in on the phone. Okay, I'll be right back.
Houston, we got a problem. Anyway, the bottom line is that Pete's been doing this for over 50 years. He has a special relationship with the Franchise Tax Board and with the IRS. The commissioner of the IRS is a friend of his. In addition to that, he knows the people very well in Sacramento, and they turn to him for advice. And he's been on a couple of strategic endeavors for the Franchise Tax Board to help them out. So he's a who's who. People fly around from around the country to meet with him to be able. I won't say he's like that beer commercial, the most interesting man in the world, but certainly he is. He's a guy who really knows his stuff as far as the tax thing is concerned. And unlike most tax people, he actually has a sense of humor. So he lives in Ventura County, and he's happy to jump on our call as long as we can hear from him today. And hopefully his volume will go up. And he's doing this just recently contracted COVID-19. So he's in isolation with quarantine, but he's still doing this today, even though he really is sick, because he felt compelled that he made a commitment and he wanted to keep it. So Pete, I don't know if you can hear me, but certainly, hopefully we can hear you soon. So I'm going to fill in some time here real quick until we get Pete's volume to come up.
Yeah, I think he's calling in right now.
Oh, is he?
Yeah.
Okay.
But go ahead and fill time.
Oh, okay. You had a question that, Julie, that you mentioned.
I have actually another question too. So we had two questions that were emailed to me, and we can go back to the one that we started talking about. I said, wait, hold on. So Anita Salomon said, a client has a mixed property, 60% residence and 40% rental, 2 different buildings, 1 lot. He wants to 1031 like for like. So to clarify, purchase new property that is 60% residence and 40% to be rented or leased. Has that changed? What are current rules? From Anita.
Nothing's changed. What happens if you're selling a property and 40% of the property is used for productive use in a trade or business or rented out, the government will look at the value, the prorated value of the entire sale, take the value, actually your CPA will do this, will take the value of the investment or the business use portion, and that's what you are required to exchange. All the cash from that portion of the sale and replacement of debt from that part of the sale. On the 60% portion, that was your personal residence, that's the part that if you qualify for it, you can take advantage of the 121 principal residence exclusion. That's the one that that came about in, I think it was 1996. And that's the one that says that if you've owned it and lived in it 2 out of the last 5 years, you can take up to $500,000 of capital gain exclusion, but only on that 60% portion that you lived in. If you're married, filing a joint return. If you're an individual, up to $250,000. But on the investment portion, that 40% portion, you either pay all the tax of the gain on that 40% portion, or you do a 1031 exchange on that. So if it's $1 million sale, you need to buy something for $400,000 or more that's going to be rental or business use. As long as it's property, it'll qualify for the 1031 exchange. Is Pete talking? He is. And Cheryl, I guess we don't
Still
have
can't
him.
hear him.
Yeah. Yeah.
He's
Poor guy.
We're gonna see.
Give me another question that you might have.
Okay, so the other one I have.
I just got a chat in the chat room.
Yeah, I got an email. Let me read my email real quick on the question, because I don't actually want to not have to look at the emails anymore. So this is from Howard. I'm not going to even try to pronounce his last name. Gottlieb?
Yep.
Okay. Howard, I have a single family residence rentals with equity and want to convert to buy multifamily. I'm in some syndications, but have been advised I can only 1031 into multiple family with a tenants in common arrangement. The homes are in Phoenix and Austin. Any problems because they are in different states with using 1031 or when using 1031. Was that
Well,
good on the question, Howard?
Yes, pros and cons of everything, yes.
Okay, so Howard, number one, we're a national exchange company, so yes, we can help you exchange anywhere in the United States. That's not a problem. But the question that I have is something that Julie was just mentioning that I want to clarify with you. You're currently in a tenant in common relationship on your relinquished properties, the one that you want to sell?
No, I own those outright.
You know, so, but you want to exchange into a tenant in common scenario.
Well, I want to invest in multifamily.
Oh, okay.
And I want to use the equity or either take a loan or sell and 1031 into multifamily.
Yeah,
but I understand you can't do that when you syndicate. And I don't have enough money really to purchase what I want on my own. So I've been told to go with a few other people. You can do it with tenants in common.
Yeah, a tenant in common thing really fixes a lot of problems. Because if you get involved in a syndication where you're going to acquire a fractionalized interest in like a 250 unit building, and you want to have a fractionalized interest, you can as long as you keep the vesting the same and the tax ID number the same from what you're selling combined into what you're going to acquire as a tenant in common, and it's equal or greater than what you sold for cumulatively with both sales, that's not a problem. You definitely could do that.
Okay.
Yeah.
And say, for example, property in Phoenix and in Texas and buying something in Texas or Florida, are there any pros and cons, any issues with crossing state lines with different properties?
No, not at all. Not at all. The nice part about it, both states, I believe, are you don't pay any state tax. So that's good.
Well, Texas for sure.
Yeah.
Arizona's pretty low.
Too, from what I think. Pete, is that right? Florida is a tax-free state?
Florida is.
Yeah. Pretty sure both are. So the bottom line is, even though we can't hear Pete yet, and hopefully Cheryl will connect him with us here quick.
Because she's trying.
Yeah, isn't that strange how you can't do that? Anyway, long story short, the bottom line is, yes, you can do that.
And then
Okay.
Andy, did that answer your question on the multi-state? So in the chat box, the question, which I think you just answered, does Exchange Resources handle 1031 in any state or in just California? So you covered that.
Yeah, we're national. No problem. Good. Any other questions that we can deal with that somebody's been asking? Anything about LLCs, partnerships, tenants in common, going into different types of properties? You know, a lot of people think you can't do that. You can do that as long as what you're buying is not a second home or a vacation home or a principal residence. Can you go into an Airbnb? Absolutely. That's not a problem. Does it have to be rented all the time? The answer is no, it does not. And remember, there are seasonal places. Seasonal, you know, the deserts, the mountains with the snow, you know, the beaches. You know, there are just some places that just don't rent all the time. Wine country, you know, the bottom line. Can you go into ag? Yeah, absolutely, because it's considered as productive use in a trade or business, and it qualifies as investment as far as the federal government is concerned. Definitely allowable. Really, the only thing that's taboo in a 1031 exchange is a second home. So if you're going to rent it out, you know, don't list it as a second home. You know, have your CPA put it on your Schedule E of your tax return. And after 2 years, you're under the safe harbor. You can utilize the 1031 exchange and go into other investment property. Here's a question: can I use it for personal use? If for example, let's say I have a property up in the mountains somewhere or by the ocean, and it's a rental, but can I use it for personal use? And the answer is yes. The government actually gives you limitations as to how much you can utilize for personal use. They'll either let you use it for 14 days a year. That's a given. You get 14 days a year. Or if you rent it out for more than 140 days a year, they will actually give you 10% of the time that it's rented, whichever is greater. So if you rent it out for 200 days a year, then you get to use it for 20 personal days. If you rent it out for 130 days a year, then you get 14 days, because 14 is the base. Anything above that you rent it out for more than 140 days, you'll get a 10% of that. So you can use it, but just don't declare it as a second home on your tax return. Declare it on your Schedule E as investment real estate.
So Peter's trying to log in from his laptop now.
Yeah, okay.
So the only other suggestion I have, if Cheryl, if you're talking to him, is whatever number he's calling in on, I'll need to unmute him, I think, too, or he's gonna need to.
Yeah, we'll try it again. Yeah, we'll try. We're working on it.
Okay.
I know there's some questions coming in the chat box, and I think Sharon Nevitt has her hands up. Folks, just hang on. We'll get Peter on here. So,
can I give you the number one while we're waiting for Pete to come back in? Can I give you the number one question I get? I speak at about 120 to 150 seminars a year. Obviously, in the last year or so, it's been pretty much exclusively Zoom. But prior to that, I'd drive up there and I'd be with you. But here's the number one question I get. This might be surprising to you, but the number one question I get is, can I convert the property to a personal residence after doing a 1031 exchange? That's the number one question I get. And you know what the answer is? Absolutely not. Number two, maybe. Number three, yes. So outside of talking from all three sides of my mouth, the question is, what is the true answer to conversion after doing a 1031 exchange? And I will give you the most accurate answer you will ever hear. Now, you may not like this answer, but it's the most accurate answer that there is. The government feels that you cannot exchange with the intent to move in. So how about if I wait for 2 years or 5 years or 10 years? No, that's with the intent to move in. You cannot buy a replacement property in a 1031 exchange and defer capital gains taxes with the intent to move in. That's number one. That's the no part. The maybe part is there is room in the code after 2 years for a conversion, but not with the intent to do so. So what is it in my life that would produce a circumstance that I can convert the property into a personal residence? The answer is something that is unforeseen or unplanned. So for example, let's say like a health issue, something like that happens, or something happens in a family issue, like a death of a spouse or divorce. Or what about something like a major financial downturn personally, where I have to occupy the property? Those are all possibilities that your CPA may approve after 2 years, but not before. And you can't buy it with the intent to convert it. Like, for example, the intent to convert it is, well, I'm going to buy it now, rent it out for a couple of years, and then I'll retire and move into it. You get caught. They're going to check. They're going to ask you tricky questions. And the bottom line is they will make the assessment as to whether or not it was done with the intent to do so. So be careful. First thing, you never answer that question to a client. Why? Because you're effectively giving them tax advice. And you can't do that unless you have a license. And number two, you have to be prepared to defend them. Are you really going to defend the client in front of the franchise tax board? I kind of doubt so. Anyway, the bottom line is that you just have to be really careful and make sure that they talk to their tax people. But just understand you can't buy it with the intent to do so. And that's a long-winded answer to a very complicated question.
That's a great points for sure.
Thank you.
Who had their hand up? Did somebody want to ask a question? I saw in the participant box, somebody, Sharon Nevitt, you had your hand up. Do you want to unmute yourself and ask Phil a question while we're waiting still?
Yes. So last week, I'm going to try to explain this. What I'm not understanding, last week I got a girl who is selling her home in Colorado for $1 million. It's a rental. She was told that she has to buy, she's going to relocate the money here because she already owns a home here, but she's going to get another rental here. She was told she had to buy another rental for $1 million because she owes the property, she owes $500,000, and she would net 500,000. So she would bring the money to California. She has to have another loan for 500,000 and put the 500,000 cash. So it's $1 million and $1 million. My confusion, and I fought this like crazy.
We can hear you, Pete, but go ahead, Sharon. We'll let
Okay, so my confusion is she was told if she puts the 500,000 down, let's say she buys for 900, she would be taxed on 100,000 because she's not replacing the loan. Why would she be taxed? A loan is borrowed money. You're never taxed on borrowed money. So why would she be taxed if she shorted her sale by 100,000, but yet she still put the 500 that she was netting into the new property?
Sharon, that's a great question. And here's the answer. Remember the short sale era that we had?
Yeah.
When the bank, when there was a foreclosure or short sale, what did the bank send to the client?
Oh, yeah. They got
Remember
taxed
that?
for it. Yeah.
Remember that? You had to
Yeah.
pay taxes on that money because they considered that was money that you got and you were forgiven, which you spent, and you never paid taxes on it. Therefore, the government wants their part. So when you do
But you paid monthly. You paid monthly. They made their money.
Yeah, well, here's the
You
bottom
didn't
line.
do that.
As far as the government's concerned, you have to replace cash and you have to replace debt. You have to. The only thing you don't have to replace in a 1031 exchange are non-recurring costs to sell. Commissions, escrow, title insurance, transfer taxes, recording fees, exchange fees. So if she sold for 1.1 and she had $100,000 of closing costs, she has leftover cash and debt. The cash and debt has to go into the acquisition of the new property. And that's what they're saying. They're saying this is an exchange. You're not gonna get deductions for your original down payment or your capital improvements or any things that you've done in terms of repair, but they will allow you to take out the non-recurring costs to sell. That's why whoever told you the answer to that was absolutely right. You have to replace all the cash. Any cash you don't replace, you pay taxes on the difference. Any mortgage that's paid off at the close of the sale, when Placer pays that off, you have to reborrow the same amount of payoff or greater. If you borrow less than the payoff, you pay taxes on the difference. If you keep some of the cash or pay for other expenses that are not recurring, you pay taxes on that difference. And that's what they were trying to tell you.
So she's paying more in monthly taxes now because she's buying for $1 million, where the other property was taxed at, she'd had it for years.
Correct.
So it doesn't make sense to me why she would even do it.
Oh, because when you come to my Basic Plus class, you will find out about releveraging and how it actually creates more rate of return for you. And then you will be able to look at it, and we'll even give you a worksheet on how to deal with this so that you can see what her actual rate of return is based on the income, the expenses, and the equity of the building. And then they can decide whether or not that rate of return makes sense to releverage, to get more, or just to keep to what she wants. Because maybe she's happy with a 3% return.
Okay, so I did it, and I didn't get audited, and nothing happened. I sold, I took the cash, the net. I did not replace the loan. I bought a property over here for all cash.
Right.
But it was probably 6 years ago. Did the rule change, or did I just I've got multiple, so probably my accountant wrote off a loss here. And
well, possibly, but let me just ask you a question. You ever drive on the 101 at 80 miles an hour?
Yes.
Did you get a ticket?
No.
Was it illegal?
It's this morning.
You get locked out?
So, okay. So
that's really what it comes down to.
I Googled it, and it said the rules had changed in 2017. So I thought, well, maybe I did it before.
They have not.
Okay.
Don't trust the internet for your tax advice.
Well, and
we
speaking,
have Pete on there now.
Yes, yeah, we do. I was gonna say it's a good segue.
Yeah. Hey, I'd like to introduce Peter Buffalato. 50 years in the business, but I already told you that.
Didn't we do that already?
Yeah, sorry, your ego's just gonna have to stay where it is. I'm not gonna grow it anymore.
Before you go anywhere else, I got to ask the question: how in the hell did Howard Gottlieb get on this, program? That is my Howard and I go all the way back to literally kindergarten in Sandbox back in at Van Alden Elementary. God, you're old.
Yeah.
He also
I'm not happy. You still have your hair and I don't. So what's up
Yeah.
with that?
Yeah, well, better DNA, buddy. So, anyways, the thing is that, and I'm pissed at this guy. I gotta interject here. I am pissed at this guy for 10 years now because
I went by to see
he
Margaret.
was probably one of the finest dentists.
She's gonna call Shay. I told her to call Shay.
Or Shay, yeah.
Well, whatever
Yeah.
his name
I
is.
think somebody needs to mute
Yeah.
themselves.
Can everybody please mute themselves? I think Rebecca, you're not muted,
More stuff in the garage?
Mhm.
Out of the-
Yeah.
Yeah.
and I can't mute it.
Well, Michael is.
Okay.
I think, yeah, because I'm not a host anymore.
Who is
Rebecca,
it?
if you can hear us, can you please mute yourself?
Rebecca.
I just muted everyone. Now Pete, I want you to unmute yourself if you would. Could you unmute yourself, Pete?
I wish you had not done that. There you
Sorry,
go.
I had to do that because somebody
Okay.
else has got a conversation and I couldn't even hear you through it.
Yeah, I couldn't hear it either. Anyways,
All right.
yeah, that's
So
the
forget
problem.
about Howard. Tell me what you have
No,
to
I
say.
gotta say one more thing. Howard and I, Howard is probably one of the best dentists, and I'm still pissed at him because he retired 10 years ago. And I've been floating around looking for a new one ever since. But Howard's a good guy. Good morning, Howard.
Thank you for the kind remarks. I don't deserve it, but thank you. Good to see you. I hope you're getting healthier.
And actually, I'm getting worse, but I'll get through it. It's a hyper version of the flu. That's what it boils down to. Anyway, so let's get on with the meeting. I'm sorry about all the technical problems. I'm not sure why all that happens, but technology is great when it works. So let's see what we can do without any other people talking over us. So where do you want to start?
Proposed tax increases this year or next.
Okay, I thought we had covered this in the last meeting with
Yeah,
this.
but it's an encore.
Encore. Okay. All right. There we go. In any case, again, for those of you who listened in last time and those who haven't, these are non-political commentary. Although Howard might jump in, but in any case, these are actual proposed positions of the Biden administration, and you can find them actually on their website, which is where I found them. The political bias has only to do with the political bias that comes from this administration. Now, I will tell you that some of the issues by the conservatives in response is hype. Some of it is real. The situation is that it will be detrimental if any portion of this passes in relationship to when Congress does look at this. But let me give a little bit of background there. Obviously, and I'm suffering from COVID at the moment, so if I fade out, I apologize. But in any case, the thing is that, and if anybody has not had it, which hopefully is most of you, if you look at the symptoms on COVID and you look at the symptoms on the flu, they're identical. It's and I'm pretty much into the the chest congestion and everything else, and I do tend to forget what I'm doing every couple of seconds. So bear with me. In any case, the thing is that the probability of the Biden administration actually addressing the tax laws is nil this year until we get through COVID. And in fact, if you listened to Fauci yesterday, you would have heard that he stated that it's probable that we'll be wearing masks well into 2022. So it appears that the situation is that the focus is incorrectly so on the issues of COVID, the pandemic, and what that's doing to the economy. The issues that the tax issues, which will which I'll address next, will actually be very contradictory to recovery. And the situation will become evident as follows. Let's start off with the increase in the income tax rates, which currently are 35 and 37%, depending upon where you fall within your income bracket. In any case, the thing is that for those who have taxable income above 400,000, the proposal, and again, these are all proposals, The proposals go back to the pre-TCJA change, which was the Tax Act that passed in 2017 under Trump. We had a 39.6% rate for most people. Again, it was above $400,000, so this is nothing new. So we're talking about somewhere between a 4.6 to a 2.6% increase in terms of the tax rates. Now, we did cover the issue that related to California last time at this point, and I'm going to cover that now as well. Probably most of you heard that the state assembly in the state of California, and these are not federal issues, these are state issues, but they affect all of us as well. This is that we were going to go to 16.8% tax rate at the highest level for state of California. That died in the assembly. It may get reintroduced, we don't know, but at this point in time, there's no discussion that that it's going to be reintroduced. At the same time, the state of California had introduced, for the first time in the history of the United States, a wealth tax. That also died in the assembly, and there is some discussion that it's going to be reintroduced, but at this point in time, we've heard nothing. And I want to jump on one other change that just took place on Friday. The situation is that under the TCJA, the Tax Corrections and Jobs Act of 2017, actually, let me again, I'm referring to the wrong law. I apologize. It's the COVID. In any case, thing is that under the laws last year under the PPP loans, and this has to do with the deductibility of the expenses. Probably most of you have heard that what happened was the IRS had taken the position that while the PPP loan forgiveness was not going to be deductible, taxable, that the expenses that were paid out against those particular items. I'm sorry, I'm getting an unstable internet message. If I lose you, I apologize. In any case, the thing is that basically what took place was that the IRS took the position that any expenses that were paid with those loans would not be deductible, therefore making the entire loan taxable. In the Tax Act that came through in December, Congress reversed the IRS on that position, but California took the position that they were going to stay with the old law, which stated that the deductions were not going to be deductible. Just this past Friday, state of California came out and said they're reversing themselves up to $150,000. So, as an example, if you took out a $500,000 PPP loan, if you spend it in the fashion that was directed for wages and rent and labor costs and that sort of thing, you now can deduct under the state of California up to $150,000 of that $500,000 loan. But at the IRS level, fully deductible at this point. So in any case, that's a nuance that just took place this past Friday. Not a great answer, but at least some relief in relationship to the state of California. All right, moving on with the Biden proposals. And by the way, if anybody has questions in the interim, go ahead and ask, and I'll answer those questions as we go along. Because Lord knows I'll probably not even remember what I was talking about by the time I'm done. Yes, it is that bad. And as soon as I'm done, I'm going back to bed. My wife is livid with me for having gotten on today. In any case, there is also the proposal under the Biden rules that there will be higher capital gains tax rate at 39.6. In other words, basically, for people who are making more than $1 million, the reality is taxable. The reality will be is that there will be no capital gains. It will revert to ordinary income tax rates. Now, that sounds like, well, okay, so how many people make $1 million? Well, a lot do, especially in Southern California, Northern California. But here's the problematic issue with this. That includes the capital gain that you would have. So the situation, let's assume that you're making $200,000 to $300,000 a year. And the situation is that you have a gain which pushes you over the $1 million mark. Guess what? You now you will come into this new rules. So what I'm going to propose, as well as the issue that relates to the 1031 issues that I'm going to get to in a bit. The situation is that if you have any pending or proposed transactions, get them done sooner. Don't allow any delays. The reason being is that the discussion is that whatever tax laws that will change, if they change this year, they're talking about making them retroactive. Now, what I've seen in the 51 years of practice, the situation is that what happens is that when you have a closed transaction, you have an and or but if code section change that says it's retroactive to such and such a date, unless, of course, you've got a closed transaction. If you have an open transaction and the law changes, you're going to be in short, water. The reality is that it's, well, I should say deep water at that point. In any case, the thing is that this is not the year to slow down transactions. This is the year to speed them up because you could get caught in any retroactive change. But again, industry, view based on the AICPA, the American Institute of Certified Public Accountants, State Board of Accountancy, and a number of other, professional organizations, we don't believe that Congress is going to get to tax legislation before the end of the year. But there's always that chance. And the history over the last 20 years is the tax laws, much like the TCJA, they get passed in December. They don't give us any time to do any planning. And that's because of the laziness of the Congress, but that's a whole different issue. In any case, capital gains rates over $1 million now will revert back to ordinary income tax rates. That's very damaging and completely blows any planning, and also changes the concept of whether or not you're going to be, something that you want to enter into a transaction at all if you're going to be paying roughly 40% of the gain plus whatever you're paying in the state. State of California at 13.3, you're now, well past half the, the transaction going to your, government leaders to do whatever they want to do with the money. In any case, there's also a provision that says that the payroll taxes for those making $400,000 or more will go up to 12.4%. Now that's up from 6.7%. So we're talking, almost doubling, and it's more than double because remember, that's not just what the employee pays, that's what the employer pays. So now we're looking at roughly 25% payroll tax burden for Social Security taxes. That's part of the proposal. Now, the other thing which is kind of onerous is that it's interesting if you look at the proposals. What happens is that those things that were beneficial in the TCJA, what I call the Trump Tax Acts, the reality is that all those things which are beneficial to the taxpayers are being stripped away. But those things which were detrimental to taxpayers, the Biden administration seems to like. So the SALT, limitations, where if your property taxes, income taxes, for your local and state taxes, your DMV, all that sort of thing is more than 10,000, Biden likes that. They're going to keep that. And what they're going to do, and we're playing a little bit of the shell game here, because part of the issue is that Congress has tried to make all of us think to be a bit more magnanimous and give to our fellow Americans, and they've allowed us to take higher, charitable donations. Not so under the Biden administration's proposal. They're talking about a 28% cap on maximum deductions for people who make more than $400,000 a year. Well, we're already capped on our medical. And heaven forbid you should have medical expenses that exceed 7.5% of your, which are now permanent. The old rule, which was 10%, has now reverted back to 7.5% on medical. But you're talking astronomical numbers to be able to get the first dollar deduction. You're limited on your, state and local taxes. So what does that leave? That leaves your donations and your mortgage interest. Well, the mortgage interest, they've kept the $750,000 cap on on the mortgage interest. So they didn't give us back the $1 million. And then secondly, the other thing is that leaves us only donations. Well, if you're capped at 28%, then what does it matter what you gave? Because the reality is you're capped. And it's going to be an increasing figure that diminishes the amount that you're able to deduct. So basically, I saw a statistic under the TCJA. Again, that was the Trump Act. The reality is over 80% of people now take the standard deduction. They just don't have enough to take the deduction because we have been limiting and limiting and limiting, what people can deduct. And the reality is, if you look at the history of tax legislature, that's been the orientation. Increase the taxes on the income and decrease what deductions are available. The Biden tax proposals are just fraught with all that sort of issue. Anyways, next item. Going over to a corporate side. This is one that again, this was under the Trump Act. This was really a misnomer. Everybody talked about how the corporate tax rates were dropped from 31% down to 21%. That was a crock. The reality was that we represent hundreds of corporate tax return clients, corporate tax clients, and we never allowed anybody to get past the 15% bracket. Just didn't allow it to happen. We would defer the income. We would find deductions. We'd use the code section 179 for expensing. We would put people into heavy pensions, that sort of thing. We never allowed them to get past 15%. Now what do we have? Flat 21%. That's a 6% increase. So again, we were lied to. But Biden wants to double down. He wants to take it up to 28%. So the reality is, again, they're looking to increase taxes across the board, and that's what's going on here. Now, moving from there to the things that are more, important to you as realtors in that industry, your industry. The reality is that this is the killer, and this is the one that we're here about today. Biden wants to eliminate Code Section 1031, completely eliminate it. That will be devastating not only to the real estate industry, but also to real estate investment across the board. It saves trillions of dollars in taxes annually, and that's why they want to eliminate it. We're giving away free money to everybody, and misguidedly in many, many cases. I can't tell you how many people I've had as retirees that have, we've taken in their tax work, and surprise, surprise, they got stimulus payments. Nothing changed for retirees. The reality is that I've got clients in the food service business that are broke, that will not, come back. The reality is that I've got people that, that are in the entertainment industry. They're in deep trouble. So again, the government has misdirected the money, and a little bit at a time. And if you calculate what the government gave to us, the reality is it works out to $1.64 a day. You can't go to McDonald's for that. The answer is they're going to, do a very devastating matter, in eliminating the 1031. Phil will jump in on this, in a moment. But the reality is that I want to cover one other particular issue, and then we're going to go back to, Phil's interpretation of what may or may not happen. But in any case, the thing is that the other part is going to be the elimination of the stepped-up basis under a state tax law. And in combination with that is that the exemption, which is now at around 13 million annually, the situation is that the Biden administration has stated it wants to drop that somewhere between 3 and 5 million. Now, granted, back to my discussion of misdirection of giving away free dollars. The reality is that if the reason for all these proposals is the government's going into astronomical debt, and they need to find ways to pay for it. And the reality is that they're looking at some major areas that will unlock trillions of dollars in additional taxes. So the reality is that elimination of the stepped-up basis can be extremely painful, because the reality is that let's assume that Howard's parents pass away. I mean, I don't remember. Howard, are your parents still with us?
No, not anymore.
Sorry, buddy.
Yeah.
In any case, And I'm not sure I've been your situation. My dad could always threaten me. He was a Depression era child, and when they went off to fight World War II afterwards, he always promised me he'd leave me his bills. So that's exactly what he did. So I didn't have anything to worry about getting stepped up basis. I'm now supporting my mother, so which is fine. But in any case, the thing is that for those who have parents that have assets as an estate that we're handling currently, farmland in the Central Valley, $16 million. The reality is that the first thing they called about was that, what are my tax implications? If I sell this, I said, nothing. And they go, what do you mean? Get it sold now. Do not wait. Don't even think about it, because if the Biden, rules pass, you will not get a stepped up basis, and whatever the cost, was in your parents' hands, net of depreciation, is the cost that you're going to inherit it. You sell it for the 16 million, you're going to pay roughly half in income taxes, forgetting the estate tax matters for the moment. So the reality is that in that particular case, and many others, the situation is that what happens is that, and I'll explain for those of you who don't understand step-up basis. What happens basically is that the government wants to tax people when they, pass away. So what they do is that they, state, okay, we're going to allow you to step up the basis to the current values. And by the way, yes, I am Italian. In any case, the thing is that
Forget about it.
yeah, there you go. In any case, by the way, anybody who missed it last night, definitely watch Stanley Tucci's Discovering Italy. Phenomenal program. I watched last night, and it's just a phenomenal program. It goes through all the cuisine of all the different boroughs and cities within Rome last night. Anyways, make sure you watch it. In any case, the thing is that, and Stanley was doing this too. In any case, the thing is that who I've met, I met him here in Park City a few years ago. In any case, the thing is that the situation is that the government wants to be able to tax things at fair market value at the at the time of death or 6 months thereafter. So basically, what takes place is that you go back and you revalue all the different properties and assets, whether they're your securities in your stock portfolio or your real estate holdings or whatever. And the situation is that you now have this stepped up value that gets taxed, less the exemption, of course. So under the current situation, less than 2-3% of Americans actually pay an estate tax. So what happens when you get that stepped up value for the purposes of the estate calculation? You now get this new value that you can use for the purpose of sale and or depreciation or anything else if you're going to hold the property. According to the Biden administration, they want to eliminate all of that. So, and that's a real problem. Between the elimination of the 1031 and the stepped up basis, we're looking at it's very difficult to hold on to property going forward. Excuse me. And then, of course, California with the Proposition 19 that passed, unless it's your residential property and you move into it, you only get $1 million exemption against property taxes. So we're looking at some real problems in relationship to holding property going forward. Now, I said that I'd have Phil jump back in relationship to what his lobby will be doing in relationship to 1031, which is very important. I'll jump back into the rest of this, momentarily after Phil and I go over the lobbyist issues.
Pete, currently CAR, NAR, the California Land Title Association, the American Land Title Association, the American Escrow Association, and the California Escrow Association are all behind us together to make sure that we will be talking with Congress to not pass this, because it will be devastating to the U.S. economy. Why?
And by the way, the AICPA, as well as the state society, is also opined on this, stating that this will be disastrous.
Yeah, and the reason why is because you remember, the economic train of the U.S. economy is being pulled by the locomotive called real estate. And the more real estate transactions there are, the more people get paid. The more people get paid, the more frequently and the number of people that get paid, two things happen. They pay income tax, which goes to the Treasury Department on the income that they make. And number two, they go out and spend money. This will slow this down significantly when you consider the stepped up basis being eliminated. And by the way, if it even is in a trust, it won't matter anymore. Isn't that correct, Pete?
That's
you will
correct.
get no stepped up basis. The second thing is the inability to exchange. Remember, the exchange requires a sale and a purchase, which means a lot of people have to go to work, including the lending community, by the way, and all the appraisers and the inspectors and everybody else. So the bottom line is that this will be devastating to the U.S. economy. And this is not the first time this has been brought up. And I personally have been back in Washington, D.C., walking the halls of Capitol Hill and meeting with congressional leaders, explaining to them pretty much what I just told you, why this is such a bad deal for America and how their congressional districts will be affected by it by virtue of the fact that they won't be making as much money.
Webinar. It's okay. It's okay.
Oh, I think somebody, yeah, okay.
Yeah, Kimberly, can you mute Kimberly? Phil, can you mute Kimberly Conte?
I will do that, right?
Yeah, DeGroot.
Yeah, okay, I gotta find her on the list. So yes, I mean, the bottom line is that, you know, all this will happen, which will create a slowdown. And by the way, the less people that are working, the more the government's gonna have to pay in terms of, you know, benefits to them for unemployment and whatnot.
Well, let me jump in there again.
Yeah.
You mentioned a very important issue. And the reality is that how tax law affects the economy. I know that a number of you were on view with us last time, but I want to reiterate what happened in 1986. I know that a few of us were around then, but the tax bill for 1986, which created a fiasco financially, was introduced by Jack Kemp, who I personally, spoke to as to, his idiocy, and he was not well pleased with being challenged in front of a group of, Republicans in Studio City by some, young upstart that said, "Jack, you screwed the pooch." In any case, the thing is that the tax reform bill of 1986, which only, again, this is the important part that Phil just touched on, which is that when the tax bill was passed, which said, if you have no money, you can invest all you want in America. But if you have more than $150,000 a year, therefore you're making money. The reality is we're going to limit your ability to buy into passive activities, which they created this new term called passive activities. Guess what got thrown into passive activities? Real estate. So therefore, what happened was that particular law passed. One moment, I'm getting a call from somebody. In any case, just to tune them out. In any case, thing is that what took place was, it was, again, just like we see today, a political vote. Of the 535 members of Congress, five members knew what was in the bill. And the reason that the bill was pushed through was that Tip O'Neill was stepping down from being Speaker of the House at that point, and Dan Rostenkowski, who was head of House Ways and Means, wanted to show Congress in total that he could handle major legislation. Well, he pushed it on political party lines. It passed on party lines. Nobody knew what was in it, and it threw this country into recession until 1996. You restrict how people can do business with each other, and they have to figure out how to do that, and it takes time. The lending, industry can't figure it out ever, as we all know, and the situation is that it takes time. So what happened is that people pulled back out of the economy, and they didn't start reinvesting in America for another 10 years. This legislation is going to do the same thing. It's going to throw us into legislation. I'm sorry, it's COVID. Don't ask my wife what she would say about that. Anyways, the deal is that, and Howard knows my wife as well. In any case, are you still sleeping there, Howard?
I wake up when Phil talks. I don't know what that means.
Yeah. Right.
Sorry, Pete. Sorry, I couldn't help it.
It's all right. All those times I sat in your chair and you yapped at me and with my mouth full of your equipment. Thank you. Anyways, the deal is that what this will do is it will, stifle, economic, transactions. And what will happen is that the economy will fail. And the situation is that this is the wrong legislation at the wrong time. We have debt levels that are just astronomical. The situation is that we need stimulus, and not the stimulus that they're handing out at $1.64 a day for Americans, and then sending money off to other economies. The reality is that, again, our congressmen don't know what they're doing, and the reality is people like Phil and the rest of us need to be active in explaining what's going to take place. There are some intelligent people there. It's rare, but the reality is that we need to be active in telling them this is the wrong legislation. If they put this into place, we are going to go into a recession that we will not dig out of for over a decade.
What about payroll taxes and the other types of things that they're proposing under the new?
Okay, well, I covered that already, but the reality is that basically anybody making over $400,000 a year, they're proposing a 12.4% tax rate, which that's up from 6.7. So the situation is that what and again, the employer has to match that. So we're not talking almost 25% payroll tax rate. And ladies and gentlemen, that's before the income tax. This is just the tax burden that's thrown on the individual, which means, let's think about that once again. Less money in your paycheck, less money in your income. The reality is you got less money to spend. The old concept that Ronald Reagan threw at us called trickle down, which has been disparaged over and over and over again, it actually works. Look at what the spending on this, what the stimulus payments, if we look just at what's happened with the stimulus payments, both last year and this last month, the situation is TV sales went up, car sales went up, every particular sector of the economy went up. People do not save money. Doesn't matter if they're not paying their rent, they're going to go out and spend it on themselves. So if you take more money out of somebody's paycheck, higher income tax rates, higher payroll tax rates, less money to go out and buy, products and services. And of course, they can accumulate for purchasing real estate.
Pete, I've got a question. What about, we've talked about these different issues. What about the estate tax in terms of the gift tax? But my question is, what happens, for example, if I have an estate and instead of it not getting a stepped up basis, can I gift it to my kids? And will there be an extra tax to be able to give them to them? Now I don't really have to go through that. There's at least a limit of what I can give away. I forget how much it is right now, but is it like 12, 13 million, whatever it is that I can give? Will I still be able to do that under this new proposal?
Well, the estate tax exemption is the same as the gift tax exemption. So the situation is that to the extent that you give away your assets, and one of the things that was very interesting in the TCJA, again, this is the Trump tax law, stating that any gift tax, any gifts that were given cannot be retrospectively changed under future legislation until that law is changed. So what that means basically is if you're using the current exemption, which is 13.4 million or whatever it is,
right?
The situation is that that's both on the estate level, and if you're married, the reality is that that's doubled up. So let's talk about the gift tax question just by itself, as you've stated. The thing is that if my wife and I decided that we were going to give up to $25 million, if we had that kind of money, but the situation she may have, I'm not sure. In any case, the thing is that
for a guy who's got COVID, you're still pretty funny. Go ahead.
Well, the first thing that happened when my wife married me back 40 some odd years ago, and remember, I'm a CPA. I've sat on two of the state boards, which is unheard of for a practice of our size, because that's usually the big political firms. And I say political firms, I'm talking about those such as Price Waterhouse and Deloitte and that sort of thing, which is where I come from. But in any case, we've got a small practice of about 7, 8 people working for us, which is a question each day with this COVID. In any case, the thing is that the first thing that she did was she said to me, "What a mess you have! Have all these accounts. I'm taking over. I haven't seen my checkbook in 47 years." In any case,
Poor man.
she allows me to live with her. Anyway, so the deal is that and I'm a happy man according to her. So in any case, the thing is that in any case, the situation is that the gift tax parallels the estate tax. So right now, you could give up to that 25 million, or if you're single, 13.4, whatever the number is. Under the Biden proposal, and by the way, people confuse that with the annual $15,000 exclusion. What that $15,000 annual exclusion is per person, by person. So in other words, if I decided I wanted to give $15,000 to each of my 4 kids, I could give $60,000 to my kids without filing a gift tax return. The exemption is really just all about eliminating, necessary paperwork that goes to the IRS. You can give $15,000 to as many people as you want each and every year. And I've yet to find my wife giving me that back. But in any case, the situation is that the proposal on the Biden proposals is to bring that down to somewhere between $3 and $5 million. So in answer to your question directly is that right now, 13.4 million and the $15,000 without paperwork. You don't have to file the annual 709, which is the gift tax return. Does that answer your question?
Yeah. Okay, that makes sense. That makes sense. So basically, we're going to not be able to give as much property away to our kids to be able to avoid this. Here's the other question.
Well, let me get to that before you answer that ask that question. Let me address that particular issue. Remember that under gifting, the rules in relationship to transfer of the value is much different than if you passed away. The situation is if you gift, then let's assume that I'm holding a piece of property, say here in Park City, and which I do. And the situation is that I bought that property, 5, 6, 7 years ago for $200,000, and today it's worth about 1.5. And I'm giving you relatively close figures on a particular property. If I gift that to my kids, their cost basis is my original cost basis.
Correct.
If my wife is, passes away, of course, she would think that it would be better than I do, and the kids get to inherit it, they get it at the stepped up basis. So therefore, if they sell, which they probably would, and they sell for 1.5, and the stepped up basis is 1.5, no tax. If I gift it to them at this point, and it's $250,000, and then the situation they sell for 1.5, they're going to pay tax on the difference, the $1,250,000. So always be very aware that gifting is not necessarily the best answer in relationship to real estate. Typically, when we talk about gifting in people's estates who have value, we're usually talking more in the realm of securities and bonds and that sort of thing. Real estate has its own particular issues that relate to, and when I say securities, I'm talking about securities that have comparable values to their original cost. So I mean, those are typically bonds and bond funds. Real estate we tend to not gift because the reality is that under the current law, the reality is that it's more beneficial that you get that property after somebody's passing, unfortunately.
So no need for a 706 tax return?
I'm not sure I follow your question.
Isn't that the last tax return of the deceased?
Aha. You're not dead until I say so. The answer is that until that 706 is filed and the audit is over with, as an example, I'm handling a very well-known individual out in California, and his estate's worth $84 million. The situation is that we were able to get that estate value down to roughly, I think when we finished up, in fact, I'm reviewing the amended returns right now. We were able to get it down to around 6 million, because what happened was, again, in relation to real estate, and I won't get into the details, but the situation, the property was impinged by the Coastal Commission. There was over a $69 million fine against the property for having done some improvements that the Coastal Commission would not approve, and then the city did, and there was a fight, and the reality is the commission now states that they're going to assert. So therefore, we were able to diminish the estate down to 5 million. We saved over $30 million in estate taxes. But the 706 is the final return of an individual when they pass away. The situation is that, and you're not dead until I say so.
Can I ask a question real quick? When you say estate value, are you talking about the retail value of what it would sell on the market, or are you talking about what it was purchased for? Okay,
remember we talked about step up. And when you say retail, I use the term market value. So that's why we bring in appraisers. And when we're doing estate tax work, the issue is we have to deal with people, estate appraisers that have been in front of the IRS, know their jobs. In this particular case that I just cited, unfortunately, another CPA firm who's well known retained an appraiser who was more of a lending appraiser. Did not ever look into the issues that were involved. We were brought in by the law firm and that was handling the state, and actually there'd been a year-long discussion as to what was going wrong, and finally they just said, you need to take this over. So in any case, we immediately hired a gentleman by the name of Mike Waldron out of Orange County, who is a very well-known estate appraiser for tax purposes. And we were able to bring that appraisal into effect relating to the assessments. But the market value is the amount. So that particular part of the property was worth about 70 million at the market value. There were impairments due to the assessments from the Coastal Commission. So the reality is that's what we were able to reduce it by. But when you ask the question, is it retail? The answer is, whether we're talking about stock portfolio. Let's assume that, I've had a stock portfolio for 50 years. I've been doing all the things that we accountants and, wealth, managers and the like tell people to do. And I've accumulated a value. And of course, my cost value is much lower than what the market value is. At anybody's passing, because I'm not going to elect to pass at this point, no matter how much COVID I've got. In any case, the thing is that somebody's passing, it is now appraised at the market value. The real estate, let's assume you've got a property in, Santa Ynez, and you bought that property 30 years ago, and it was $125,000, and today it's $1.8 million. It's the market value. And that's what the reason that they get the stepped up value, because remember, the estate tax after exemptions is 55%. I mean, that's a huge tax.
55?
55%.
This is under the new proposal or currently?
Current.
What would go to with the new proposal?
They have not discussed rate. I think they think that rate's excessive enough. But in any case, I mean, it's real simple. Who cares whether it's 55 or 60%? The reality is, the bottom line is that if you take 13 million down to 3 million in relationship to the exemption, you're going to capture a lot more people at 55%. In fact, you're going to, I haven't seen the latest statistics, but I think the answer is that it brings roughly another, right now they're capturing about 1 to 2% of, estates and actual tax being, collected. I believe that that factor will increase by at least 20–30%. So the situation is that that's a lot of tax. So the answer to the question is that the reason we get the stepped up basis is because they want to tax it at that rate. If the exemption goes down, they're going to get more that will be taxed at that rate.
This is a big deal, ladies and gentlemen. This is a really big deal. And
Well, you can't give away trillions of dollars in free money and not figure out how to get it back. And so the thing is that the position of the Democrats have always been tax the rich. Well, if you look at what if you really start to understand the Internal Revenue Code and the estate tax codes, the reality is rich isn't all that rich in America in relationship to what they will tax. If you look at just at the income levels to what they consider as to being wealthy, you're making $176,000 a year. Then you're considered wealthy. That's when all the exemptions and benefits and tax credits have completely eliminated themselves. And of course at a number of levels, the advanced income tax credit, the credits for education, the earned income tax credit. They're all gone by the time you get to 176, and long before that. But the reality is, above 176,000, you're considered wealthy. And the reality is that what they're looking to do is tax more and more. They say $400,000, but the reality is, you look into the code. The reality is that that's where the taxes really start to bite.
So Phil, I want to ask another question then in regards to investors. So we have a lot of, we have realtors on here and brokers and lenders. So in regards to investors, do you see them selling that investment property because of these proposed tax increases that are coming down? What do you think will happen?
well, I still think the best thing to do is to exchange, especially while we have it now. And frankly, I am somewhat cautiously, and I mean very cautiously optimistic that, remember, it isn't just the White House. It's the Congress that we have to convince, especially the Congress, because they're going to say no or they're going to say yes. And if we can cut it off at Congress, which I don't think we can change the White House's opinion, I mean, the bottom line is that could make a really good impact to what Pete has been talking about today, at least from the 1031 exchange and the things, and hopefully from the stepped up basis kind of position. I think, remember, if you can sell and buy, you can still 1031 exchange, as long as this exchange is here. So you'll do both. But if you eliminate that part of the exchange, then what are you going to do? Maybe you'll just refinance and take money out of a property and buy another piece of property. That could be an option, certainly. But I don't know, Pete. I mean, where would you go from here?
Well, you just put it, on the nail head. The reality is that if you're going to pay an excessive tax, there's no, impetus at that point to exchange. So what you will do is that if you're sitting on a lot of equity, much like a buddy of mine I got off the phone with yesterday afternoon, he's worth probably north of $100 million. Started off like the rest of us with nothing, and he constantly refinances his properties to acquire more. And the situation is that I think that's where the market will go. I think basically if you have to pay this, excuse me, I apologize. If you have to pay this horrendous penalty for being successful, you're not going to do that. You're going to borrow money and leverage and buy another piece of property.
That's really interesting that you say that, Pete, because the state of New York has a refinance tax that we don't have. And I just wouldn't be surprised if the feds would, and I don't want to put conjecture into this, but what if they come up with a refinance tax? Because that's what people will do, and maybe it seems like they're taking away incentive to.
Well, again,
again,
this is not a political statement. This is a historical statement. The Republicans, forgetting all about all the other issues that people get, irritated with what the Republicans do, their position is laissez-faire, basically allowing the business community and the populace to do what they're going to do, and then tax the results. The Democrats on the other side have always been going all the way back to FDR. Is tax. I mean, remember, we had a 90% tax rate all the way up through Eisenhower. The situation is that the Democrats have always taken the position, tax it first, and we'll redistribute the wealth in whatever manner, and it never works. The reality is that the economy blossoms when under a laissez-faire approach, and there's more tax revenue doing it that way because it's not constrictive. So the answer is that we're currently in a situation where we've got a tough political position in relationship to business America. The reality is that we have a Democratic administration that wants to tax. They've asserted so. We have a House which is primarily Democratic, which they typically don't know what they're voting for when they vote. I mean, that's historic. Nancy Pelosi was not the first one to say we have to pass it so that we can understand it. Congress constantly does that. And the situation is that she was the one who was stupid to say it. But the reality is Congress has done that, time and time and time again. Again, I've been doing this for 51 years this season, and the situation is I look at these things and I just question every time, what are you people thinking? I've represented over 6 political campaigns, which I will not do anymore. And it doesn't matter whether they're Republicans or they're Democrats. These people don't know what they're talking about. They literally don't. There was one who is both a CPA and an attorney who I asked questions of on a technical basis, and I watched his eyes swirl. I mean, the reality is he had no clue. And yet he's got 2 professional licenses that would say that he should know better. These people don't know what they're talking about, and yet they're the ones who lead us. In any case, bottom line is that we'll see what Congress does, and the reality is that right now I'm telling people if you're going to get into an exchange, do it sooner than later, get it done. But the reality is that. Again, those are not as easy as they always sound. I mean, the reality is that I think that if legislation passes and we lose the 1031, which hope to God that doesn't happen, the reality is that they'll have a problem with closed transactions. They won't have a problem with open transactions.
I may have to apply for a job with Placer Title because I'll be unemployed.
Well, I'm sure. Yeah, I was going to say, I'm sure Julie would hire you, my friend.
Yeah,
so I think this might be a good segue, Julie Forrest. Do you want to ask and see if anyone has questions or?
Yeah, does anybody have any questions while we still have? I know we're running over a little bit. We got a little late start. We covered some of the questions that were asked at the beginning. Any specific questions you'd like to ask our experts that we have on the call today?
Is there anything about the tax code that Pete Muffletto doesn't have memorized?
Only what doesn't come back to mind when he's got COVID.
Hey, Howard, it's what I do.
You do it well.
So I put their contact information over in the chat box as well. Is there anything, Pete and Phil, that we haven't asked that we should ask in regards to 1031 tax exchanges, et cetera?
At this point, we're going to get more into those details when we get together next time in March. We're always available if you have any questions. Don't hesitate to call it in the chat box. My phone number's there, our email is there. There's no obligation.
And same for me. Same for me. Email me or give us a call. Always best for me to be emailed because then I can manage the time to get back to you.
There's one more thing though, Pete. You offered last time, I think. You have a 3-time to 5-time a week bulletin that you put out of changes that the IRS is making or things that they're beginning to scrutinize. Is that still available to our viewers here who would like to see what's happening from that point of view?
Yes, anybody that wants to get on our distribution list, I'll be more than glad to add you. There's no cost. I cover between 3 and 5 articles a week. I'm also published in a number of professional organizations. I've been published in the LA Bar Journal. I've been Apartment Owners Association picked up 2 of my articles, both in October and November. I do the very condensed bulletins that I put out in the emails. So anybody wants to add on, just send me your email and I will be more glad to add you to that list. And of course, if anything comes up that you have a question about, email me. I'll be more glad to get back to you either by phone or by email.
Thank you, Pete, and thank you for being on here today when you are completely under the weather.
Yeah, we really appreciate it.
Absolutely.
We do.
I do want to say one other thing. No, this has to do, this is, no, I'm not going there, Phil. Or Howard. Any case, and I will call both of you afterwards. Any case, the thing is that whatever your political outlooks are, it doesn't matter in relationship to what I'm going to say next. To protect all of us and the economy, look into whatever political associations you have and definitely get your opinion known that you do not want to see the proposals that relate to the elimination of the 1031 or the estate tax changes. I think we have much more, political clout in saving 1031 than we do in relationship to what's going on with the estate, because that's more of a political issue. And I'm not going to address that any further. But do make sure that your voices are heard on the 1031 matter, and it's going to be extremely important.
Great advice, Pete. Thank you. Julie, did we, I don't know if we got that one question from Ellen Washington that was over in the chat box. I think this is for Phil. It says, can you go over 1031 options to buy something for a smidge higher price? I read something about 5% higher. Did you guys already cover that?
No, there's no limit. When you do a 1031 exchange, you can go as high as you want based on whatever you've identified. So if you sold for $600,000 and you want to buy for 16 million, it's no problem, as long as you put all the cash from the sale or you bring in new cash and you bring in debt. So the bottom line is you can go as high as the sky. In terms of acquisition, it's just going down is where the government has an issue. That's where those boot issues come in, where you pay capital gains taxes on the difference of cash that you don't reinvest. And then of course, any debt that you don't replace that was paid off on the sale. Those are always there. That's a standard. And the government just wants you to go equal or more.
Thank you.
Okay, last chance to get any questions in if anybody has anything, and we're gonna call it good for today, and we are recording this. So if anybody wants a copy of this, and then March 22nd, we will have, what specifically are you gonna be going over, Phil?
Basic plus. We're going to, okay. It's not 87 octane, it's not 91 octane, it's 89. So that's what we're gonna do. And it'll be leaded coffee. And the bottom line is that we're going to talk about a lot of these issues that we're talking about today, but then a lot more. And lastly, how to market yourself, how to get in front of people right now, considering the environment of the tax situation, in terms of getting them to rethink about releveraging while they can without having to pay taxes on the sale by releveraging the equity by doing a 1031 tax deferred exchange.
Awesome.
Well, thank you so much. Really appreciate your time. And Pete, get better. You know, take a lot of vitamins, drink a lot of fluids.
Thank you. All right, I am going to leave the meeting. I'm done.
Thank you so much. Thank you, everyone, for taking the time.
Thanks, everyone. Good webinar. Good info. Thank you.
Thank you, Howard. Thank you.
Have a good day. Get out there and get in front of people. They're waiting to hear.
Thanks, everyone.
Thanks.
Bye.
Welcome.
Bye.